If the last 2 decades have taught us anything about the world of money, it's that the old, dusty advice about just buying stocks and holding them, well, it's fundamentally sound, but it's also completely incomplete
Oh, absolutely. The investment world has gotten so much more complex and faster.
and more opaque, honestly. It forces the everyday investor to really, catch up.
But there is one single product out there that feels like the ultimate cheat code.
Right. It offers these shortcuts to deep diversification, to tax efficiency, to instant market access. We're talking about the exchange traded fund, the ETF.
It's absolutely true. The ETF fundamentally changed how modern investors interact with capital markets. I mean, it democratized high-level investing.
It did. It packaged all this complexity into just a simple tradable share.
But that innovation, it comes with a new layer of complexity and risk. And you have to understand that part.
Today, we are not dwelling on the basic definition of an ETF. We're going to go deep. We're diving into the cutting-edge mechanics.
How continuous arbitrage keeps the price honest, for example.
And why they are taxed superstars in specific accounts. We'll also get into how to spot the hyperactive, high-risk versions you should probably avoid.
And then we're going to build on that knowledge, right? Move into a bulletproof investment strategy, exploring the absolute laws of diversification, compounding.
And finally, we're ascending to the Nobel Prize-winning logic of systematic factor investing.
This deep dive really is the blueprint for financial intelligence. We're pulling from foundational knowledge on ETF mechanics, some high-level strategy principles from, leading firms like Vanguard, and advanced asset pricing models like Fama French.
And our mission is to move you past just the definitions.
Right, so you can use these vehicles strategically to optimize every single aspect of your portfolio.
That sounds like the most powerful mission statement in finance. And if you want the full breakdown of complex finance topics simplified and made actionable, make sure you subscribe to Money Mindset.
Okay, let's get into it.
Let's unpack this. We start, of course, with the building block itself, the modern investment shortcut. Okay, let's begin with the core definition and then, immediately leap into why it matters. An ETF, an exchange-traded fund, is an investment fund.
Right, it holds a basket of financial assets.
Stocks, bonds, commodities, currencies, crypto, you name it.
But the genius, really, is in how that ownership is structured and how it's traded.
Exactly. The fund's ownership is divided into shares, just like a regular stock.
And, crucially, those shares are bought and sold on major stock exchanges throughout the entire trading day.
So, in essence, it bundles the diversification of a fund.
With the real-time liquidity and trading flexibility of a stock, it's sort of the best of both worlds.
Okay, so here's the key difference, and this is the first immediate actionable takeaway. How does the ETF structure functionally separate itself from its older traditional cousin, the mutual fund?
It all comes down to timing.
Yeah.
And operational capability.
Timing. Explain that.
Well, if you want to buy a traditional open-end mutual fund, you place your order, but you only know the price, the net asset value, or NAV, once it's calculated after the major U.S. exchanges close.
So after 4:00 p.m. Eastern Time?
Exactly.
Yeah.
Your order executes at that single end-of-day price. It doesn't matter if the market was wildly volatile at 10 a.m. or perfectly calm at 2 p.m., you get one price.
The ETF just throws that whole model out the window entirely.
Completely. ETFs trade continuously at market prices from 9:30 a.m. to 4:00 p.m.
And that simple shift in timing, it unlocks all these sophisticated trading tools that mutual funds just can't offer.
Because they trade continuously like a stock, you can execute complex trades. You can do margin buying, which is purchasing shares with borrowed capital.
Or short selling, betting against the fund.
Precisely. All these tools that are just off the table for mutual funds.
And more importantly, for the everyday investor, it allows for a kind of tactical precision that mutual funds deny you.
That's a great way to put it. You can use limit orders.
Meaning you can specify the exact maximum price you're willing to pay.
Or the exact minimum price you're willing to sell for. You're in control.
You can also deploy stop-loss orders, so you can automatically sell the asset if it drops below a point you've already decided on.
And these mechanisms are just. They're unavailable with traditional mutual funds. With a mutual fund, you only get market orders that execute hours later at a price you don't even know yet.
And this continuous pricing, this all relies on robust liquidity, right? For the really popular ETFs, like the ones that track the S&P 500, we're talking about staggering volumes.
Oh, tens of millions of shares traded every single day.
Wow.
And that high liquidity is a non-negotiable requirement for an efficient ETF. It creates what we call a tight bid-ask spread.
The bid-ask spread. So that's the little gap between the highest price a buyer is willing to pay the bid and the lowest price a seller is willing to accept the ask.
Exactly. So if a buyer is willing to pay, say, $100, and a seller is asking for $100.01.
That 1 cent spread is tiny. It means trading is cheap.
Correct. When an ETF is highly liquid, that spread is tight. The cost of trading is minimal. But here's the warning.
I was waiting for it.
The flip side is the hidden cost of those specialty, thinly traded niche ETFs.
Right. If you have some thematic fund that tracks, I don't know, Peruvian small cap mining companies,
That spread can widen out considerably, just because there are fewer people trading it.
and that wider spread, it acts as a very real, if hidden, trading cost. And the investor absorbs that every time they enter or exit the position.
And it doesn't matter what the advertised expense ratio is. This is a separate cost you're paying. It's a key detail people so often overlook.
Okay, beyond liquidity, let's hit on the real structural brilliance of the ETF, especially in the U.S. tax code.
You're talking about the tax efficiency.
The tax efficiency that comes from its operating mechanism, it's almost magical.
It is. I mean, transparency is easy enough to grasp, right?
Right.
ETF issuers generally have to publish their portfolio composition daily, or at least quarterly.
So you have continuous pricing visibility. You know what you own.
But the tax advantage, particularly in a standard brokerage account, a taxable account, that's where it really earns its superstar status.
And this advantage is almost entirely due to the in-kind exchange component of the arbitrage mechanism.
It's a crucial distinction. And to really get the solution, we have to first clearly define the problem that's inherent in the traditional mutual fund structure.
Lay it out for us.
So when a shareholder redeems shares in a mutual fund, the fund manager often needs cash to meet that redemption request.
Makes sense. Someone wants their money back.
Right. And to raise that cash, the manager often has to sell appreciated share securities within the portfolio that have gone up in value.
And when the fund sells those appreciated securities for cash,
Exactly. The fund realizes a capital gain. And by law, that capital gain must be distributed to all the remaining shareholders in the taxable account, usually at the end of the year.
this is the dreaded capital gains distribution.
It is. The retail investor gets a surprise tax bill, even if they never sold a single share themselves. You are passive, but you still got hit with a taxable event created by someone else's actions.
That feels profoundly unfair to the long-term holder. It's like you're being punished for someone else leaving the party.
It is. And the ETF structure brilliantly sidesteps this. It turns the fund itself into an intermediary that almost never has to sell appreciated assets for cash just to satisfy redemptions.
This is where the in-kind exchange comes in.
Exactly. When an authorized participant, and we'll get into what those are in a second, but think of them as a large institutional player, when they redeem a huge block of ETF shares, the ETF issuer doesn't give them cash.
What do they give them?
Instead, the issuer executes an in-kind exchange. They hand the AP a basket of the actual underlying portfolio securities, the stocks, the bonds, whatever mirrors the fund's holdings.
Okay, that's the equivalent of me returning a toaster to a store and the store saying, instead of cash, here are the raw components we use to make that toaster. The wires, the metal, the heating element.
That analogy is perfect. And because the fund didn't sell those appreciated securities for cash, it never realized a capital gain.
And if the fund never realizes the gain,
There's no capital gain distribution to pass on to the retail investor. It's that simple. The retail investor only realizes a capital gain when they decide to sell their shares for a profit.
that's incredible. So the fund can continuously flesh out the low-cost basis shares, the oldest, most appreciated ones, without triggering a taxable event for everyone else.
That's what makes them so much more tax efficient than mutual funds in those taxable accounts.
It's just an elegant financial solution. It's leveraging the regulatory structure to benefit the long-term passive investor.
It is, but it bears repeating.
Yeah.
If you're holding these funds inside tax-advantaged accounts like an IRA or 401k, this specific tax benefit is, well, it's irrelevant.
Right, because those accounts already shield you from capital gains taxes. So this is a huge deal for your standard brokerage account, but not for your retirement account.
Right.
So that tax efficiency we just talked about, it's a direct result of the core engine room of the ETF.
Arbitrage mechanism.
Yes. For you listening, this is the magic that keeps the ETF share price, which is floating around on the stock exchange, from wildly deviating from the actual value of the assets it holds.
The net asset value, or NAV.
Right, and this whole function is managed by these specialized financial institutions.
known as authorized participants, or APs.
APs.
These are massive broker-dealers who act as specialized market makers. They are the only entities that deal directly with the ETF issuer.
Like a Vanguard or a BlackRock.
Exactly.
And they're not buying single shares like we do. They're transacting in these enormous blocks known as creation units.
Right, we're talking 50,000 shares or more in a single go.
And their motivation is just simple profit, isn't it? But their activity is what ensures the market price always stays tethered closely to the NAV.
The core of the arbitrage loop works just like this. APs spot discrepancies. That's their whole job. If the ETF is trading at a premium, so above its NAV, or at a discount below its NAV, the AP is incentivized to jump in and close that gap.
Walk us through the premium situation first. Let's say, because of a sudden surge of retail buying on the open market, the ETF share price temporarily spikes, let's say 0.1% above the actual value of its holdings.
APs see this arbitrage opportunity immediately. They go out and buy the underlying basket of assets, the actual stocks or bonds or commodities, which are now cheaper than the ETF share price.
Because the ETF is at a premium.
Right. Then they take that basket of assets and they swap it with the ETF issuer in exchange for a new creation unit of ETF shares. This influx of shares is called creation.
And then they immediately sell those newly created ETF shares on the open market. They lock in that 0.1% profit minus their transaction costs.
Correct. And by increasing the supply of ETF shares on the exchange, that flood of supply pushes the market price back down toward the NAV. The premium vanishes.
And I assume the reverse happens if the ETF trades at a discount, if the share price falls below the NAV.
You got it. If the ETF trades at a discount, APs buy the cheap ETF shares on the open market. They bundle them into those big creation units.
And redeem them directly with the issuer.
For the underlying, more valuable basket of securities, they pocket the difference. And that reduction in the supply of ETF shares on the market pushes the price back up toward the NAV.
And that redemption phase, just to connect the dots, that's often where that tax-efficient in-kind exchange we talked about occurs.
That's the one.
So the APs are essentially continuously policed by the market itself. They're incentivized by these little short-term profits to ensure the ETF price tracks the NAV accurately.
Their self-interest serves the efficiency of the entire structure for you, the retail investor.
So the efficacy of this arbitrage mechanism is really, it's paramount.
It's everything. It's what ensures the continuous pricing on the exchange is reliable. It lets you and me execute trades accurately without worrying that the fund's price is somehow decoupled from the real value of what it holds.
So the core product is sound. It's efficient, it's transparent. But the ETF universe is not monolithic, is it?
Not at all. We really need to categorize these funds because they span the entire risk spectrum.
From, boring, passive giants that are crucial long-term tools.
All the way to volatile, hyperactive products that can be incredibly dangerous if you don't know what you're doing.
Okay, where do we start?
We start with the foundation. Index ETFs. These are the most common type. They're passively managed.
Meaning the fund's objective is simply to mirror a specified benchmark.
Like the S&P 500 with funds like VOO, IVV, or SPY, or maybe the Russell 2000 for small caps with IWM. These are generally the lowest cost and most straightforward.
And these passive trackers, they generally use one of two methods for tracking that index, right? Especially if the index is really large.
Precisely. They might use what's called full replication, which is exactly what it sounds like. They hold every single security in the index in the correct proportion.
Simple enough.
But for massive or illiquid indices, that's not always practical. So they use representative sampling.
Okay, sampling. What does that mean?
It means the fund might invest, say, 80% to 95% of its assets in the core index securities. And then the remaining portion, up to 20%, is in things like derivatives, futures, or other holdings that help the ETF achieve the index's objective without having to own every single potentially illiquid underlying security.
Got it. Okay, now we move across the spectrum to actively managed ETFs. Here, the manager is not just replicating, they're executing a specific trading strategy aimed at outperforming the benchmark.
Yes, the manager is the key variable here, and this introduces a trade-off.
Higher fees, for one.
Higher fees, historically.
Yeah.
But in the ETF structure, there's a specific risk related to the required transparency. Active managers are generally required to publish their holdings daily.
Unless they are these designated active, non-transparent ETFs.
Right. But for the ones that do disclose daily, that sounds like a dream for high-frequency traders.
So what's the risk? What's the technical term?
The risk is called front-running.
Front-running.
If the market knows your fund manager is planning to buy a massive block of shares tomorrow morning because the fund published its holdings today, Well, other traders can anticipate that demand
You can buy the shares immediately.
and then sell them back to the active ETF at a slightly higher price. It hurts performance. That's why some active ETFs try to mitigate this by trading infrequently or using those non-transparent structures.
Can you give us a concrete example of a popular, actively managed fund to bring this to life?
Sure. The JP Morgan Equity Premium Income ETFs, or GPI, is one of the largest and most successful.
The API, I've heard of that one.
It employs an option writing strategy to generate high monthly income. But this complexity in active management, it translates to higher fees. JPI charges about 0.35% annually.
Which is several times higher than a passive S&P 500 tracker.
It is, but it's still pretty low compared to a lot of traditional actively managed mutual funds.
Okay, next up are thematic ETFs. These seem to multiply daily. They focus on these really specific trends like space travel, robotics, or I don't know, sustainable aquaculture.
Right. They tap into that desire to bet on a specific trend.
And these can be index-based or actively managed, right?
They can, but they all share a major challenge: the subjective nature of defining what's actually in that investment universe and the inherent hype.
I've heard about this. The SEC has been cracking down.
We've seen significant regulatory scrutiny recently. The SEC has charged investment advisors with AI washing,
AR wash.
essentially exaggerating their involvement in AI or clean energy
Right.
just to exploit market enthusiasm and attract inflows.
So if a fund says it's focused on metaverse technology, you, the listener, need to look past that sexy name and actually scrutinize the underlying methodology. What stocks are actually inside this basket?
Absolutely. You might find a fund that's titled Robotics and AI is actually 60% standard industrial manufacturing companies and only 40% cutting-edge tech. The labels can be very misleading.
And often these thematic funds underperform broader market indexes over the long run.
They do, because their focus is just too narrow, or it's too trendy, and they've caught the top of a hype cycle.
All right, this is the segment where we need to put on the brightest possible warning lights, especially for new or casual investors. Let's talk about leveraged and inverse ETFs, or LETFs.
Okay, the enthusiasm for these is always high because they promise these dramatic results. They're seeking a daily return that corresponds to a multiple, like 2x or 3x.
Or the exact inverse of an index's performance for that day.
Right, but this is a critical insight, and if you hear nothing else, hear this. LETFs are designed for daily results only.
Daily.
They achieve their leveraged or inverse goal through aggressive use of derivatives, swaps, and futures contracts. And this requires constant internal rebalancing at the end of every single trading day.
So the danger lies in holding them for longer than a single trading session. Walk us through why that daily design is so mathematically destructive for long-term investors.
It's because of a devastating phenomenon known as volatility drag, or sometimes called volatility tax.
Volatility drag.
Over any period longer than one day, their performance will diverge wildly from the stated multiple.
Okay, give us an example.
Imagine a 3x leveraged ETF tracking the S&P 500. Day 1, the S&P is up 1%. Great, the ETF rises 3%. Day 2, the S&P is down 1%.
So the S&P is basically flat over 2 days. You'd think the 3X fund would be too, right?
Not at all. Because of the daily rebalancing, the volatility just drags it down. The fund manager is forced to constantly rebalance to maintain that fixed leverage ratio. They have to buy into the index as it rises and sell as it falls.
So on day 2, that 3% loss is applied to the new higher value from day 1.
Exactly. The small loss compounds negatively every single day there is volatility, even if the index finishes exactly where it started a week later. They are not compounding vehicles, they are short-term trading tools. Full stop.
So if I bought a 3X ETF and the market just went up 1% one day, down 1% the next, up 1%, down 1% for a week, the index is flat. But my 3X ETF is bleeding capital every single day.
Precisely. Because of the necessary internal trading to maintain that leverage, they are fundamentally unsuitable for buy and hold investors. They should only be used by experienced traders with a very, very short-term, specific directional view.
The losses from volatility drag can just wipe you out.
They can eliminate even moderate gains very quickly.
Okay, good warning. Next, let's briefly touch on synthetic ETFs. These are more common in Europe, but they still exist here. They track indexes using derivatives and swaps instead of owning the physical securities. What's the key risk they introduce?
The key risk here is counterparty risk.
Counterparty risk.
Since the fund doesn't physically hold the stocks or bonds, it relies on a swap provider, usually a major investment bank, to promise to match the index return.
And if that provider defaults?
The ETF loses its ability to track the index. Now, while collateral is posted to mitigate this, the quality and liquidity of that collateral can sometimes be dubious.
And that's raised regulatory concerns.
Due to the complexity and the lack of transparency, yes.
And finally, commodity and currency ETFs. For certain commodities, like gold, the ETF structure means they hold the physical asset in a trust. GLD is a good example.
Right, they've got the physical bars in a vault.
But others, like the United States Oil Fund, USO, they only own futures contracts.
And owning futures contracts exposes investors to a really complex set of risks involved in the futures term structure, specifically something called contango and backwardation.
So the cost to roll, to sell the expiring contract and buy the next month's contract can be really high.
It can be. And that creates a significant negative cost that can drain returns even if the underlying commodity price is flat. This rolling cost is a distinct risk that those physical-backed ETFs just don't face.
Let's turn to the newest, fastest-moving segment of the ETF world, crypto. Following the launch of spot Bitcoin ETFs, this space is just booming.
It is. And we have to distinguish between spot crypto ETFs versus futures crypto ETFs.
What's the functional difference?
Well, spot ETFs invest directly in the underlying asset Bitcoin or Ethereum, tracking its real-time market price. Futures-based ETFs, which were actually approved first, they invest in contracts to buy or sell the crypto at a future price.
And because of the differences in valuation and liquidity in the futures market, the share prices can diverge, right? Even if they're referencing the exact same underlying asset.
They can. Spot ETFs are generally considered superior for tracking the physical asset price.
And the regulatory landscape here was just dramatically reshaped. It was that 2023 U.S. court decision that essentially forced the SEC to reconsider its denials.
Right. It cleared the path for the first U.S. spot Bitcoin ETF.
That led directly to the SEC approving 11 spot Bitcoin ETFs in January of 2024.
And then, in a similarly pivotal moment, they approved spot Ethereum ETFs in May 2024. But
there's always a but.
The Ethereum approval came with a highly specific and crucial condition, and it dramatically affects the potential returns for you, the investor.
And that condition related to the proof-of-stake mechanism of Ethereum, didn't it?
It did. The SEC specified that the approved funds were not allowed to stake their tokens.
Okay, explain staking for us.
In proof-of-stake systems, staking is essentially lending your tokens to help secure the network. And in return for that service, the holders receive a substantial yield or rewards on the coins they hold.
So if the ETF can't participate in staking, they lose out on that yield, which is basically guaranteed income just for holding the asset.
Exactly. And the financial cost of that regulatory constraint is not small.
How much are we talking?
Well, according to estimates from issuers and analysts, the funds would lose about 3% of potential annual returns by being barred from staking.
3% a year.
For a fund holding billions in Ether, that amounts to tens of millions of dollars in lost annual rewards.
And I imagine the issuers might try to compensate for this lost income by charging customers higher fees.
Which means you, the retail investor, end up paying the cost of that regulatory constraint.
Wow.
Just a huge potential drag you have to bake into your calculation.
Absolutely. Okay, let's pivot to a curious little detail from the early operations of these spot ETFs. The dust problem.
Ah, yes, the dust problem. It's a great example of traditional finance meeting this novel technology and just failing to account for the weird side effects.
So because the ETFs are dealing in Bitcoin, they sometimes inadvertently get ownership of these trace amounts of other non-Bitcoin tokens.
Tiny fractional amounts of other dust tokens. It's part of the transaction processes inherent in blockchain technology.
I remember reading about BlackRock accumulating small amounts of tokens they never intended to buy. Why is that a problem? Why not just sell it and clean up the account?
The issue is twofold, and it stems from the ETF's prospectus, its legal documents. First, selling or passing on this dust could technically imperil the ETF's legal status because it deviates from their stated objective, which is only to hold Bitcoin. Second, and this is the logistical headache, selling or distributing that dust would force millions of investors to receive and then file complex tax paperwork related to these tiny, unexpected virtual assets.
It would be a compliance and accounting nightmare over what? $30 worth of mystery tokens?
Precisely. So the policy for major issuers is often just to hold these unintended assets in a separate wallet indefinitely, or to make a small charitable donation.
It's a bizarre, persistent logistical headache. just created by the conflict between traditional finance law, which requires clean asset ownership, and the messy reality of blockchain transaction flows.
It's a perfect little microcosm of the challenges ahead.
All right, now that we understand the vehicle, the ETF, let's pivot to how you actually use it to achieve long-term success. We're moving from mechanics to strategy.
And we're focusing on two foundational principles: compounding and diversification.
We hear the advice to diversify all the time. Don't put all your eggs in one basket, but we need to dive into the mathematics of why it actually works.
Diversification is often cited simply as risk reduction. Avoiding catastrophic failure if one stock, like an Enron or a Nortel, just collapses.
And that's true, but you're saying that's only half the story.
It's only half the story. The true mathematical benefit is what drives long-term wealth creation.
So what's the surprising insight here?
The core benefit is reducing the drain on compounded performance caused by the volatility of returns.
Okay, say that again.
It reduces the drain on your compounded performance that is caused by volatility. Risk, when you measure it as volatility, how much your returns fluctuate around the average, it doesn't just make the ride bumpier. It actively harms your long-term compounded growth.
This is where we need to bring in the math of volatility drag to prove the point. The relationship is approximately: average compounded return is equal to the average periodic return minus
Volatility squared too. That squared volatility term, which is always positive, is the hidden enemy. It's always subtracting from your returns.
Let's use a simple conversational example to make this real. Imagine two portfolios. They both earn an average return of 10% per year.
Okay. Portfolio A is steady. It returns exactly 10% every single year. Portfolio B is volatile. It returns 50% one year
Wow.
and negative 30% the next. So the average is still 10%.
Right, 50 minus 30 is 20, divided by 2 is 10, okay? So portfolio A starts with $100. After 2 years, it grows to $121.
Simple enough. Now, portfolio B, the volatile one, starts with $100. After year one, it grows to $150.
Great start.
But then it drops by 30% in the second year, so it drops to just $105.
Oh, they did that math wrong?
Sorry, 150 times 0.70 is 105.
Right.
So even though the average return was 10%, the compounded return was far, far lower. The volatility absolutely killed the growth.
That's incredibly powerful. Now let's apply that to real-world financial data, comparing a 100% equity portfolio to a balanced portfolio.
Let's look at the periods from 1990 to 2014. We'll compare the Russell 1000 index, which is 100% equity, versus a balanced 60% equity, 40% bond portfolio.
Okay.
The Russell 1000 had a strong 11.5% periodic average return. However, its high volatility, which was 18.49%, meant its actual compounded return was only 9.82%.
So it created a 1.68% drain from volatility drag.
Exactly. And if we run the calculation using the formula, 18.49% squared divided by 2 gives us about 1.71%. It almost exactly matches the observed drain. The math is relentless.
Wow.
Now look at the balanced portfolio. By adding 40% treasury bonds, which actually had a negative correlation with stocks during that period, the portfolio's volatility dropped significantly.
How much?
Down to just 10.63%.
Lower volatility, dramatically lower drag.
Precisely. The volatility drain on that 60-40 portfolio was only 0.51%. Because the drag was so much smaller, the compounded return, which was 9.54%, almost matched the 100% equity compounded return of 9.82%.
Even though it had significantly lower risk and lower exposure to equities.
This illustrates it perfectly. Diversification isn't just about smoothing out the ride. It actively works to lessen the mathematical drag on your long-term compounded performance.
That leads to the most crucial, actionable takeaway. If diversification works by maintaining a certain level of balance to keep volatility low, you can't just set it and forget it.
No, you have to actively maintain that balance.
You have to rebalance.
Absolutely. For diversification to deliver those benefits, to reduce volatility and maximize your compounded returns, the portfolio must be rebalanced.
So if equities outperform bonds for 5 years, your initial 60-40 portfolio might drift to, say, 7-5-25.
And you've unintentionally increased your volatility and your risk exposure.
So rebalancing, maybe annually, maybe quarterly, means selling the assets that have risen, the equities, and buying the assets that have lagged, the bonds, to bring the allocation back to that target 60-40 weight.
It is forced financial discipline. It forces you to systematically sell high and buy low, keeping your exposure constant and your volatility drag minimal. Failure to rebalance is a huge source of unintentional risk-taking.
Finally, we should briefly touch on the theoretical underpinning of this all. The efficient frontier concept.
Right. It's the graphical representation of all the portfolios that maximize return for a given level of risk.
It's beautiful in theory.
But its core limitation is vital for you to understand. It relies entirely on historical data, historical returns, historical volatility, and historical correlations.
And past performance is absolutely no guarantee of future results.
Exactly. We are concerned with future returns, but the model can only use the past. For instance, the efficient frontier derived using data from the 1990s might suggest a 100% bond portfolio returned almost 8% annually.
We can't expect that today.
Not with the current low level of interest rates.
Yeah.
If you blindly follow a historical efficient frontier, you risk being optimized for a market environment that just doesn't exist anymore.
Let's put these concepts of discipline and balance into a practical, actionable framework. Let's use the 4 principles of investment success developed by Vanguard Research.
This is great because it shifts the focus from external market forces, which you can't control, to internal investor control, which you can.
Let's start with Principle 1, goals.
This requires defining clear objectives. Is it retirement income? A major purchase? Leaving a legacy? And understanding your constraints, your time horizon, your risk tolerance, and critically, your capacity for loss.
A 20-year-old has a huge capacity for loss. A 60-year-old nearing retirement does not.
Exactly. And the major insight here is realizing the power of your savings versus the power of returns.
Everyone focuses on market returns. They're exciting, but they're unpredictable and totally outside our control.
But savings, the amount we actually contribute, is entirely within our control.
And over a long 30-year horizon, Vanguard data shows that savings contributions and investment returns contribute roughly equal amounts to achieving the final goal.
But for shorter horizons, like 5 years, nearly 80% of the goal is achieved through savings alone. If you want a powerful lever for success, focus on maximizing those contributions first. That factor is entirely under your command.
Okay, Principle 2 is balance. Asset allocation. We touched on this with diversification.
Right. This mix of investment stocks, bonds, cash, international, it determines the likely range of returns you're going to experience.
Historically, a higher stock allocation means higher average returns, but greater volatility and risk of substantial short-term losses.
But the inverse carries a silent risk. Avoiding stocks altogether because you fear short-term volatility means you risk not achieving sufficient growth to outpace inflation over the long term.
So while cash is less volatile in the short run.
Equities are the engine of long-term growth. They are necessary to achieve those inflation-beating returns.
Principle 3 is cost. This is the ultimate, non-negotiable, actionable takeaway. It's the principle that led to the rise of low-cost ETFs in the first place.
Cost-expense ratios, transaction fees, bid-ask spreads, and taxes, they cut directly into your returns.
This is a mathematical fact.
It is. Lower-cost funds have historically and statistically outperformed higher-cost funds across every single asset class. It is the single biggest predictor of future relative performance.
And the compounding effect of costs is just brutal.
It's brutal because you lose not just the fee itself, but the potential growth on that lost fee year after year after year.
Let's put some numbers behind that brutality. If you have a $100,000 investment over 30 years and you compare a 0.1% annual cost, which is typical of a low-cost ETF,
versus a 2.0% annual cost typical of an expensive old-school mutual fund, what's the damage?
assuming a consistent 8% gross return, the 2.0% cost portfolio would result in a final balance that is over $240,000 less than the lower cost portfolio after 30 years.
$250,000 lost, simply to fees.
And you're paying that fee regardless of performance, so you have to minimize costs aggressively.
You must.
And that brings us to Principle 4. Discipline. You've defined your goal, you've set your balance, and you've minimized your costs. Now you have to stick to the plan.
This involves regular contributions, which smooths out market timing risk through dollar-cost averaging, and staying invested through the inevitable volatile markets.
The biggest enemy of the investor is the emotional decision.
It really is. Studies show the cost of fleeing to cash during sharp market downturns like the 2020 COVID crash is immense. Investors who stuck to their 60-40 allocation recovered rapidly and earned superior returns.
Compared to those who panicked and moved to 100% cash.
And then they missed the powerful subsequent rally.
And discipline also requires that regular rebalancing we discussed earlier.
If you let a portfolio drift without rebalancing models show, a standard portfolio could unintentionally drift from 60-40 to something like 76% equity and 24% bonds over 2 decades of bull markets.
And that uncontrolled drift means you are exposed to far higher risk than you ever intended.
Discipline demands you sell some winners and buy some losers annually to keep your risk profile constant and your volatility drag low.
Okay, we've covered the mechanics of the ETF and the foundational laws of investing, which focus largely on controlling risk and cost. Now let's elevate the discussion to advanced theory.
We're talking about the underlying economic forces that explain why some assets consistently outperform others.
We're moving beyond the simple idea that higher risk equals higher returns to a Nobel-winning analysis of what actually drives performance.
This is the realm of factor investing. Historically, investors assumed risk could only be measured by how much a stock moved relative to the entire market.
That's the core idea behind the capital asset pricing model, or CAPM. It uses only one variable, the market excess return.
Right. But factor investing posits that there are other systematic, measurable characteristics or factors of stocks that historically lead to higher returns, independent of or in addition to that overall market risk.
And smart beta funds are the ETFs that embody this principle.
Exactly. They're index funds, but they deliberately go beyond simple market capitalization weighting. They compose their index by ranking stocks using these preset measurable factors.
So it's a kind of sophisticated low-cost middle ground between passive indexing and high-cost active management.
That's a great way to think about it. And the foundation of this theory is the seminal work, the Fama-French three-factor model, introduced by Eugene Fama and Kenneth French in 1992.
And their analysis basically demonstrated that CAPM was incomplete.
It was. Fama and French argued that CAPM, which explained about 70% of diversified portfolio returns, missed two critical, persistent drivers of returns. Their model added two factors to the classic market excess return, and it boosted the explanatory power to over 90% of returns.
So what are these three foundational factors that explain almost all portfolio movement?
Okay, they are. One, market excess return. That's the return of the market portfolio above the risk-free rate, the classic CAPM factor.
Okay.
Two is SMB, small minus big. This is the size factor. It measures the historic tendency for small-cap companies to outperform big-cap companies over long time horizons.
And number three?
Number three is HML, high minus low. This is the value factor. It measures the historic tendency for high book-to-market ratio stocks, what we often call value stocks, to outperform low book-to-market ratio stocks, which are growth stocks.
Okay, let's break those two additions down conversationally. Why did they find that small cap stocks, the SMB factor, tend to outperform large caps?
Well, the academic hypothesis is usually rooted in greater risk. Smaller companies are just inherently less diversified, they're more volatile, and they're less resilient to economic downturns than giants like Apple or Microsoft.
So to compensate investors for taking on that higher systematic risk.
Small cap stocks historically delivered a premium return. The size factor captures this systematic exposure.
And what about the value factor, HML? What makes a value stock one with a high book-to-market ratio outperform a growth stock?
The book-to-market ratio is a core measure of relative cheapness. High book-to-market stocks are often mature companies that are out of favor. Maybe they're facing temporary headwinds, or they're just deemed boring by the market.
And growth stocks, conversely, are priced for perfection. Their market value is extremely high relative to their book value.
Exactly. Value stocks tend to be systematically cheaper. And studies suggest that investors tend to systematically overpay for excitement and growth, leaving value stocks undervalued and poised for mean reversion. And thus, they deliver a higher long-term return premium.
So the three-factor model tells us that your portfolio's return is largely determined by its exposure to the overall market, small companies, and value companies.
That's the core thesis. And it dramatically improved our understanding of asset pricing. However, there were limitations to this three-factor model, especially when you apply it globally.
Right. The factors weren't equally powerful everywhere.
Exactly. The size factor, SMB, often performed poorly in emerging markets compared to developed markets. The value factor, HML, seemed to retain its explanatory power globally, but the inconsistency suggested the model wasn't quite complete.
And that incompleteness, coupled with new insights into accounting data, led Fama and French to publish a significant revision in 2015.
Which brings us to the next level of complexity. The Fama-French five-factor extension from 2015. They kept the market size and value factors, but they added two new factors based on the quality of a company's fundamentals.
Okay, what were the two new factors?
They added two new factors that relate directly to the operational health and capital spending of a firm. The first is profitability, RMW, robust minus weak.
Okay.
This measures the difference between the returns of firms with robust or high operating profitability versus those with weak or low operating profitability. And the second is investment, CMA, conservative minus aggressive.
Investment.
This measures the difference between the returns of firms that invest conservatively, meaning they have low asset growth, versus firms that invest aggressively with high asset growth.
So if I buy an ETF that filters for high profitability, the RMW factor, what am I capturing?
You're capturing the quality premium. Profitable firms, those with strong, sustainable operating income, tend to outperform less profitable firms. The idea is that quality firms are simply better businesses, and over the long term, strong fundamentals win out.
And the investment factor, CMA. What does conservative minus aggressive investment mean in practice?
It means that firms that reinvest less of their earnings back into growing their asset base, the conservative investors, have historically delivered better returns than firms that aggressively try to grow their assets rapidly.
What's the insight there?
The insight is that aggressive investment often signals overconfidence, or poor capital allocation decisions, or simply too much optimism baked into the price. Conservative investing, focusing on efficiency and high returns on existing capital, seems to be a more reliable driver of returns.
What's fascinating is what happened when they added these two factors, profitability and investment, to the model. It kind of cannibalized one of the original factors.
That's right. In the U.S. data from 1963 to 2013, adding these factors made the original value factor, HML, redundant. The returns attributed to HML were almost entirely explained by the other four factors.
Specifically the investment factor, CMA.
Yes, it showed a correlation of 0.7.
So the five-factor model suggested that value stocks often outperform, not just because they were cheap, but because they were often the firms that were also highly profitable and investing conservatively.
Precisely. The five-factor model provides a richer, more mechanistic explanation for the historical value premium. However, even the five-factor model still failed statistical tests in fully explaining the expected returns of all portfolios.
Especially those composed of small firms that invest aggressively despite having low profitability.
The academic pursuit of the perfect model continues.
And the final piece of this advanced puzzle always comes back to momentum, doesn't it? If we're systematically harvesting these factors, why is the highly persistent momentum factor so often excluded from the FOMA French framework?
Well, FOMA and French, being highly focused on rational, economic, risk-based explanations, originally excluded momentum, the tendency for prior month winners to continue winning and losers to continue losing, because it smells strongly of behavioral bias, not risk.
But the debate persists.
It does. The Carhart four-factor model, an extension that predated the FOMA French five-factor model, specifically added a momentum factor, MOM, arguing that even if the source is behavioral, the premium is persistent and you can harvest it.
And the smart beta ETF universe allows investors to systematically select for all of these factors: size, value, profitability, and momentum in a low-cost, systematic way.
That's the key. It makes this academic theory accessible and actionable. #outro.
We've covered a massive amount of territory today. We've moved from the practical mechanics of the world's most efficient investment product all the way to the underlying Nobel-winning theoretical forces driving global investment returns.
Let's try to summarize the most crucial takeaways for you, the listener, to ensure this knowledge translates into superior portfolio management.
Okay, first on ETFs. Remember, the tax efficiency is a structural gift, especially in your taxable brokerage accounts.
And it's the arbitrage mechanism, specifically the use of in-kind exchanges during the creation and redemption process, that prevents the fund from realizing capital gains, thereby protecting you from those surprise tax distributions.
Second, in portfolio construction, diversification is necessary, but it's not enough.
You have to implement the discipline of rebalancing to actively maintain your risk profile and reduce that volatility drag on your compounded returns.
Without rebalancing, the powerful math of lower volatility compounding faster is just negated by unintentional risk creep.
Third, focus maniacally on cost.
It is the only factor you can truly control. And we saw how small differences in annual costs can compound into devastating losses, easily $250,000 over decades.
Lower-cost products have historically outperformed higher-cost products, period.
And finally, Recognize the power of factor investing. Whether you use a basic index ETF or a specialized smart beta fund, your portfolio's returns can largely be explained and enhanced by systematic exposures to the market, size, value, profitability, and investment strategies identified by the FAMA French models.
Which brings us to our final provocative thought for you to mull over.
We have these incredibly sophisticated models, like the FAMA French five-factor model, that attempt to explain over 90% of returns based purely on measurable, rational economic factors.
Yet, even with this sound mathematical framework, the difference between success and failure for the retail investor often seems to hinge entirely on behavioral risks.
Our own lack of discipline, our tendency to flee volatility or buy the trendiest thematic ETF or just ignore costs.
The models are sound, the data is clear, but the human element remains the ultimate unpredictable variable. Are we fighting market risk, or are we just fighting ourselves every time we log into our brokerage account?
Food for thought. Don't just listen act. Go forth, diversify, minimize those costs, and maintain your discipline. And of course, make sure you subscribe to Money Mindset.